Welcome back to the channel, everyone. I know I missed last month, so I'm making sure I do this month, and from here on in, you'll definitely have them. Best ASX stocks for March 2022. Let's get into it, guys. No fluff. If you enjoy the content, as always, please subscribe to the channel and hit that notification bell. So as always, not a financial professional, guys. I'm sure all of you know this. Have a read if you're worried. Theme of the month is very, very similar to the previous video. It's inflation, but we've got the added Russia-Ukraine crisis, and the growth meltdown kind of continues. It's slowed down, but it's still there. So what's going on? Inflation is clearly rife and much higher than expected, both in Australia and abroad. So just look at the price of fuel, food, rent, housing in general. Pretty much everything has gone up in price. We're all facing significantly higher costs across the board. The Russia-Ukraine war is causing commodities to rise even higher, which is, I guess, a good and bad thing for Australia. The environment has very much moved to risk off. Look at the crypto markets, which are proxies for risk appetite. Crypto is still kind of suffering. It's had a little bit of an uptick. And obviously the Russia-Ukraine war has shown, just how powerful cryptocurrencies are when you can't access your money due to, interventions by governments, geopolitics and the like. Given the higher risk backdrop, we're all waiting to see how quickly the Fed and RBA now move to raise rates. Like before, it seemed like, bang, they're going to do it right now. Now, let's see. I'm pretty sure it's tonight that the Fed is going to make an announcement, and we'll see when the RBA does it as well. So with stocks, the Fed's probably going to be a bit more important than the RBA. And at the end of the day, the Fed will probably force the RBA to do it in a sense. But this is a very tricky and delicate situation that they're balancing. So what am I doing? As always, guys, these videos are a starting point just to let you know this is what I'm thinking, what I'm doing, and this is kind of just a basis for you to then go and do more research on. I basically keep this and create a shopping list each month, and I actually narrow down my shopping list. I make it my better, higher conviction names in there. I don't always buy what's in these lists. They're just research, and I'm just sharing it with you. I'm still keeping a shopping list of the things I've wanted to buy, as always, especially things that I thought were expensive. But now they've gotten, a bit cheaper. Things since my last video, things have gotten a little trickier. Not 100% sure where we're going. That's why I prefer to, go through and find the best stocks, so high quality names. With the growth stocks, I go through and see what's being hit hard, but what I think is a really good business, and one that's not going to get too hard, smack too much. That means that they're probably going to be profitable or close to it, or they're just a very, very good business. They should have small amounts of debt, and they're not relying on crazy future projected cash flows and valuations. As I said, I go back to basics. I want to find high quality names, safe businesses that will do well in inflationary environments, so a bit more defensive. And since the last video, it seems to me that commodity inflation is here to stay. So looking heavily in that space, Australia should benefit from this, as I said. I am still very heavily invested in US stocks, guys, particularly, in growth or tech names, because that's where the biggest names tend to be. More on this to come in later videos. So as always, I'm going to cover off my mid and large cap names. The first being Woodside Petroleum, ASX ticker WPL. So what's Woodside Petroleum? So it's an Australian oil and gas company involved in hydrocarbon exploration, valuation, development, production. Basically an oil company, guys. They've got a portfolio of offshore platforms, oil floating, production storage, and offloading vessels. Currently trading at $31.15. It's got a market cap of 30.2 billion. It's got a PE ratio of 11, and it's currently trading towards the upper end of its 52-week trading range. It's got a dividend yield of 5.85%. So, bit of a dividend payer there. As you can see, this is definitely not the highest this stock has ever been in the past. Doesn't mean it will hit there, but if any indication of what the oil price has been doing, this has potentially still got some upside in it. Particularly noting that at the moment, given a slight pullback in the oil price, this may give us an opportunity to get into this name. Now, the reason I've selected this, guys, as a potential kind of stock to look more into is As I said, oil's been on a big run in the last 3 months. It's gone from $65 to $130. This means they're going to make higher revenue and profit for these types of businesses. So Russia-Ukraine crisis has made this even more evident and even more prevalent, because as the restriction of supply happens through companies not buying Russian oil, or Russian oil being disrupted and coming onto the market, then this is going to obviously put a dent in that supply. Demand's still strong, and obviously the price will continue to go up potentially. So that's kind of my thinking. Recent pullback in oil is going to give us a potential opportunity to get into quality names like Woodside. There's plenty of others that you could go into that are far more risky, but this is probably the safer of the oil stocks on the ASX. I don't see the oil price abating too much. There's been such little investment due to the push for green energy. Whether that's wrong or right, this is just my thoughts on oil in terms of the price of it and how it will relate to Woodside. I'm not in any way saying that green energy is bad or wrong. Supply chain issues, shipping, etc. will keep prices high. Demand has spiked due to pent-up demand from lockdowns. Neither OPEC, Russia, or the US have increased their production. This does take time. Whether or not they're planning to do it, I actually haven't really seen. So this all points to a high oil price. Maybe not higher, who knows, but definitely a high oil price. The next stock, guys, is Xero Limited, ASX ticker XRO. So what does Xero do? They provide a platform for online accounting and business services to small and medium businesses. It is a New Zealand public technology company listed on the ASX, which deals in the cloud-based accounting software platform for small and medium-sized businesses. So basically, accounting software. If you have a business, you've probably used it. It's currently trading at 95.78 with a market cap of 14.3 billion. It's actually trading towards the low end of its 52-week trading range, so it's traded between $90 and $156. In terms of PE, it's still not profitable, so definitely a bit of a higher risk compared to some other names, but a phenomenal business. So Xero is one of the highest quality ASX tech names. The recent pullback gives us a really good opportunity to get in a much more attractive price, right? Whether or not it keeps going down lower, I'm not sure. It could potentially, if the market sentiment continues towards growth and tech stocks like this, it very well could keep dropping, but the business is sound. It's an extremely sticky product. One, you'll use it and you won't likely leave. It's very hard once you start using accounting software to leave. It continues to grow in both Australia and New Zealand and other regions of the world. So it's up 560,000 subscribers year on year. It does struggle a bit in North American markets where there are more established players. So at some point their growth will stall, but that growth has not stalled yet. It's becoming a small and medium business solution rather than just accounting software. So there's lots of stuff they can keep selling to people, particularly through their app store, which is going to be a key driver to driving more profit for years to come. Great business. I think it's looking at a relatively attractive price. If you can get it even lower, awesome. One definitely for the longer term. The next is TPG Telecom, ASX ticker TPG. So what do? They're an Australian-based multimedia full-service telecommunications company providing consumer, wholesale, corporate telecommunication services. The business offers voice, internet, and data solutions to a range of customers from consumer to SME, corporate, and government sectors. Basically a telecommunications company. You would have seen them. So they're trading at $5.61, 52-week trading range of 481 to 725. So definitely on the lower end of that. Market cap of 10.43 billion. Nice little dividend yield of 3%. Obviously a very high PE ratio, but earnings are growing. And I believe that this is the incorrect PE ratio. As you can see, it's traded significantly higher in the past. And I'll let you know why I think this might be worth a look. It's fundamentally a very strong business that's well managed. The telco industry continues to grow at a fast rate, and TPG will benefit from this growth. The Vodafone merger and deal to expand their mobile offering using Telstra assets will help them continue to grow. Recent earnings miss led the market to penalising TPG hard, hence the markdown in the price. Their management team's long-term vision and commentary seems to still be very, very positive. They're focusing on like 2025 and onwards. Again, the drop in share price gives us an opportunity to get in at a much better price, particularly if you're looking for some exposure to the telco side. This is a much faster growing business than, say, a Telstra. Next section, guys, is the interesting higher risk and small cap names. So these are definitely riskier, definitely ones that you want to take even more caution with because of the size and the potential for, particularly in this environment, of a drop in price due to the risk off appetite. The first is Pact Group Holdings Limited, ASX ticker PGH. So while these are more risky names, I've tried to pick ones that are as safe as can be in the risky category, right? So what do? They're a leading provider of specialty packaging solutions, servicing both consumer and industrial sectors. So they're a packaging company. They specialize in the manufacture and supply of rigid plastic, metal packaging, materials handling solutions, contract manufacturing services, recycling and sustainability services. They're currently trading at $2.34, so towards the lower end of the 52-week trading range, 223 to 463. They've got a market cap of $805 million. They also do pay a fairly nice dividend of 4.13%. So my investment thesis, it's quite a defensive business. So it's a packaging manufacturer, which is perfect for a rate rising environment. You know, they've got defensive cash flows that are temporarily impacted by commodity pricing. They should be able to pass some of these on. They're using technology to offset a lot of these, and they're focusing on recycling resin to bring down these costs. The COVID supply chain issues have temporarily impacted their business, so this is going to give us an opportunity to buy at a lower price. It is a profitable business that pays a dividend. It's still quite small, so it's an interesting area to look into. I'm definitely going to keep looking into this and may do a deeper dive into this business. So the last company, guys, is OFX Group Limited, ASX ticker OFX. What do? OFX Group Limited, they're formerly called OFX Group. So if you ever sent money online, you may have used them. If you've ever sent money overseas, you may have used them. They're a provider of international payment services for consumer and business clients and foreign exchange services. They're currently trading at $2.30. 52-week trading range of $1.02 and $2.47. So they're actually trading towards the upper end of that range. It's got a market cap of $569 million. So my thesis, great management track record that executes well and keeps their promises. The recent acquisition of Firma Foreign Exchange Corporation gives them a leg up into the North American market. So they've recently bought a business. This will significantly increase volumes in major currency pairs, such as USD, Canadian, and the like. It's a stock that's defied the recent market pullback, which is always good to see. You want to see what does well in a market pullback because holding that may mean it might cushion the fall of your portfolio. While the share price has been on a run, it still seems cheap on a historical PE basis. So on a PE basis, doesn't look crazy expensive compared to a lot of names out there. So guys, I hope you've enjoyed the content. Please subscribe to the channel, hit that notification bell, and I've got heaps of nice content coming out. Look forward to talking to you all in the future.